You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome to Mining Stock Education. On today's episode, you'll be hearing from me, Brian Leni, a resource sector investor and editor of Junior Stock Review Premium. I'll be giving you an introspective look at what went right and what went wrong in 2023 for me. I think it's a great opportunity for you to learn from my mistakes and hopefully avoid them. Plus, I'll be giving you 5 things I think you can do in 2024 to be a more successful and consistent investor. So let's start off with the negative. Where did I go wrong in 2023? I definitely made a few mistakes, and I think it's best encapsulated in terms of the timing of my investments. None of these points I'm going to cover are necessarily new to me, but the mistakes, I definitely overemphasized that I need to be better in them. And I think it starts with selling more in those 5 momentum frenzy type settings. And, these are these bull market type settings I need to be better at selling. Over the course of my investing career, which has, been over 10 years, I've had 2 years in particular that I've done very well in. There's the 2 bull market years, which is 2016 and 2020. And looking back, especially to 2020, I think I give myself a medium grade in terms of what I sold, but I definitely didn't sell enough. And that is a problem now looking back over the last 2 years, but in 2023 and how that has kind of carried over. In 2020, I did take profits and I moved some of them into new opportunities, and I took a portion of it and put it into real things. I think that's actually even a side point that could even go with the things that you should do better in 2024 is when you have profits. I think in the junior resource sector, obviously you take them and you move them into new, cheaper opportunities, but you have to be putting that money into real things. Junior companies are floating abstractions. In some cases, these companies have nothing but a hope and a dream, and it's that company's ability to sell that dream to the market. And if they're recognized, that's kind of where their value comes from. And you need to take hold of that idea and make sure, you're putting money onto your mortgage on house improvements. Maybe you need a new vehicle. Maybe you can invest in a real business that's cash flowing, or maybe even further education for yourself. All of these are real things that I think you need to have at least a portion of your profits going into at all times. And especially in those years, those bull market years, you need to take full advantage of them and execute in that way. So I give myself a medium grade. And really what I say that is because looking back on the performance over this last year and how it's tied to 2020 and how I redeployed that money, I could be better with my timing. One of the points that I'll also kind of go over is, I think I'm a fairly self-aware person, and I make it a priority to be one. My competency level puts me into a lot of investment in developers, and I'll define developers as companies that are sort of pre-resource. They've already made their discovery. They have a resource or maybe an economic study. And these companies are highly susceptible to the Lassonde curve. And more and more I invest in this sector, the more I'm reminded that I need to better align the market cycle with the company cycle. If these are aligned, and you have full recognition of where that company actually is and where the market is, I think you can make the timing aspect work out much better for you. And, some cases, you're probably better to have your money in cash or some other part of the market, maybe a producer that's got cash flow sort of regardless of where that metal price is, to keep your money in that hold period until the timing is right. Now, nobody has a crystal ball and can tell where markets are headed. But I think there is that sort of sweet spot where you can get better with your timing, and that's what I'm trying to talk about. And again, next to my competencies, the other thing I like about buying the developers is that they have intrinsic value in themselves. Having a resource means there's actually something in the ground, and that you can assign a value to, and you can compare it to how the market's valuing it. And this is really how you're going to make money, is by buying those companies with intrinsic value that are selling for less than they're worth, and then hopefully they have a good plan on how to get market recognition moving forward. And of course, you're going to make mistakes across this. It's just getting better at it, and that's where I know I can be better moving forward, 2024 and beyond. The last point I'll leave you with, and it definitely is something that I had to remember or catch myself not confusing is the difference between inevitable and imminent. You can come with a logical sort of order of things, and you can say, wow, if this and this happens, then absolutely this has to happen. Yes, that's probably true, but it doesn't say when. And this is the big difference between inevitable and imminent, is timing. I'll use a perfect example, and it's one that I've thought a lot about, is the 2008 crash. 2008 happens. It's a worldwide catastrophe financially, leading into the States, but many other Western nations especially had to do the same thing. They flooded the market with liquidity, meaning, quantitative easing, and they lowered interest rates to ultra low levels. Housing markets go crazy, this and that go crazy. And really, I thought to myself, wow, we have to be on that precipice of this thing falling apart and, finally getting everything back. Everything's going to have to go back to more sound money principles and such. The fact is, it's just not that way, or it's not that way in the, imminent, as I thought it was. Really, you look at since 2008, the last, whatever it is, like almost 15 years, things have moved along at a snail's pace. And besides COVID happening in 2020, really in the gold market, we could have been sitting in the same position, as we were in 2013, 2014, 2015. I'm not sure that necessarily anything else would have happened, just kind of floating away sideways. And so it does show you that, you can form a logical argument for something, but it doesn't mean it has to happen tomorrow. And whether that's with this green revolution or the gold market and the amount of debt in the system, or whatever you want to look at, oil market, uranium, everything can logically line up, but it doesn't mean it has to happen tomorrow. And thus you have to make sure that you're not totally reliant on that timeline as the leading principle of why you're investing, and hence why you can't use commodity pricing as the reason to invest, because getting that right is super hard. And it's a lesson that I think, unfortunately, everybody typically has to learn by losing money. So that's the negative side, or where I went wrong. So let's talk about the positive side. Where did I go right? 2023 has been a positive year from a portfolio standpoint, especially if you compare it to 2022, which is pretty brutal. I made a couple picks at the end of 2022 and then the beginning of this year, or new investments. And out of those 4 or 5 picks, the top 2 were really good. Sold one for a good profit. The other one we took some profits on. The middle 1 or 2 did kind of nothing. And then the last point was definitely a mistake. And it was a mistake of over optimism, I suppose. But again, a good learning experience, but it sort of leads into this other point that I had that I think I did well, is selling positions early in the year and sort of early in the investment to ensure that it didn't get worse, and that I avoided sitting in Q4 this year, which ended up being terrible. Now it's popped up the last 2 weeks of November and into December, but you just never know when that's going to happen. But, for those that waited for Q4 to sell, you sold at a drastic price reduction compared to the beginning of the year. Because I don't know if you recall, but, especially in the precious metals market, there was some optimism heading into Q1 of 2023. And, that's when I took advantage of cutting some positions, taking some profits. And as soon as the market sort of rolled over, I was very happy that I did. And it just shows moving forward, I need to cut things that aren't working as soon as possible and not wait to the end of the year to sort of get rid of things. This flows into another point. I think patience has definitely been a big point. Besides those 4 or 5 picks that were amongst probably a 2 or 3 months time span, I really sat on my hands. And for a lot of people, especially as a newsletter writer, that's not the reader's most favorite thing. Everybody loves the picks, but I think sometimes it's wise to do so. And to me, it was wise to do so basically the last year and a half, unless, you pick that right market. I missed the uranium run up. And I think, obviously if you hit that, then that's great. But unless you're doing that, sometimes it's wise to sit on your hands. And in 22 and 2023, we had companies that were, putting out good news flow, and their share prices were selling off. They were being used as liquidity events. And when you see that sort of price action happen, I think that's a great time to slow down with the market and sort of take every moment as you go. And if you have that certain buy target that's cheap enough for you, then by all means, you start buying, and you buy in tranches over a certain period of time. But slowing down and being patient is probably a good way to be, almost regardless of what market you're in. And as I said before, out of the plus 10 years that I've been in a resource sector investor, really there's only been 2 years where you really wanted to push the momentum. And that, I think it just shows you that being patient is a bigger part of it than being impatient. So now we'll move on to 5 things I think you can do to be a more successful investor in 2024. The first one, use level 2 market data. And for the newbies, and I'll be quite honest, I didn't really know what level 2 market data was all about until I started to use it. And so really, I'll start from the level 1 perspective. When you go into your brokerage account and you want to get a quote on a company and you want to see what the bid and the ask is, that's your level 1. It basically tells you where the bid is, where the ask is, and sort of the size. You don't see anything else. If there's a lot more selling above that minimum ask price, or if there's a lot more buying potential below that buy price, you have no idea. You're blind to it. And until you get that level market data where you can see that, you have no idea. And I tell you, after using that for the last 4 or 5 years, I think 100% it pays for itself. This level 2 market data, it usually has a cost, but I think it's included in basically every brokerage firm out there, $30, $40, $50 per month. There's also a couple other websites. CEO.ca is one that has a nice visual format. It's a little costlier, but then again, there's some other advantages to how their system is set up. But it all depends on you. And especially if you've never used it before, then I would suggest that cheaper version, get used to it, and then you can expand on how much information you want to digest and how you want to digest it. But I tell you, after using that for, again, the last 4 or 5 years, there's no way I would move ahead without it. And to me, it's invaluable and more than pays for itself, especially in these hard markets. Point number 2, open an interactive brokers account. Now, I have no affiliation with Interactive Brokers, no sponsorship, no nothing. I've just used IB for a while now, and especially being a newsletter writer that has a lot of international subscribers, probably the number one question I get outside of if I like this company or that company is, what brokerage should I use, especially considering I'm not Canadian or live in Canada and have a Canadian account. And I always tell them Interactive Brokers. You get an IB account, you can basically trade on almost any exchange. You can buy these Canadian-based companies on their home exchanges, not derivatives, but the OTC or whatever. You're going to get the maximum liquidity. The best price action is going to come on those home exchanges, the TSX and the TSXV. It's got great exchange rates. Sometimes you're going to have arbitrages between the different exchanges because you have access of them in one account. Again, you can play those arbitrages if need be, or if that's something you want to do. So again, I think there's a lot of value, especially for international investors, to have an Interactive Brokers account. And I think, again, it's a huge advantage over, let's say, an American who has just your regular American bank account or brokerage account that only trades OTC. I think there'd be a major plus, and if there is a cost, I don't think there is. But not having it, the Interactive Brokers account is going to be a big advantage for you. Point 3, type or handwrite a 1-page summary outlining exactly why you're investing in a company. You're going to want to write how much you think it's worth, what catalysts are going to propel it higher in valuation, and of course, what price you're going to sell it at. For me as a newsletter writer, I continually write all my thoughts down, including the recommendation articles on a new pick. And I'll tell you, it's 100% a major factor in why I've been successful more consistently over the last, 7 years since I've been doing this full time. It makes you crystallize the investment thesis. You go through it in a logical manner. You go through that base value calculation. It's quantitative. There is definitely some qualitative, especially if you're in the exploration companies, to try to sort that out, how you're going to place value on a company that essentially has nothing. But it forces you to do it. And then once you have that baseline value established, you need to sit there and think, okay, well, why is the share price going to go up? Why is the market suddenly going to take recognition? Besides the metal price going up, which is definitely one of the factors. But remember, there's a plethora of other things that can happen to make a share price go up. So you need to sort that out, and you need to sort it out over a certain timeline. So you write all this out in a very concise and compact format. And then finally, and arguably the most important point that it gets most overlooked, is what price you're going to sell at. Price targeting is something that you're not just going to pull out of your head. You have to say, okay, this is the base value. This is what the company is going to do in the next year. And this is what the share price should be after they've added all that value. Once they've done all that right, for most people, that's going to be the time to sell. And of course, it's market dependent, but these are the steps I think that most investors are going to have to take. And it'll solidify not only why you're investing in the company, but it'll also catch you if you've got too much emotion in the decision you're trying to make, or you're getting out of your competency level. Point number 4, read Managing Oneself by Peter Drucker and Seeking Wisdom by Peter Bevelin. I'm a big promoter of self-awareness. I think everybody needs to be self-aware, but especially as an investor. I think it plays so much into our success because almost like with point number 3, people have a tendency to get up in the clouds. They let a sales pitch, kind of direct them into something that they're really not or really shouldn't be in, such as exploration. That requires a lot of geological knowledge, requires a lot of time to go through news releases. And you can get lost in it though, because it's so sexy. And so I think you definitely need to, first, you take heed of what you know and what you don't know, what your risk level is. You read Peter's book because he's going to tell you all about human bias. And this is something, no matter how well you know yourself, just being a human in general, you're going to be susceptible to the bias. Those 25 biases or 26 biases. And Peter's going to take you through exactly what they are. And then once you have an idea of human behavior and who you are, I think you need to have a format for managing yourself. And Peter Drucker's book is, widely held as one of the best out there. And so I think these are 2 great books to start with. And this is a great lead into point number 5. Create a list of 10 rules which you'll stick to in 2024. And what you're trying to do here is you're trying to create a framework for decision making. No matter the market, bearable emotion can creep in and you can get off of where you want to be headed, and it can take you out of your comfort level or your competency, and you want to avoid that at all costs. And so I'll suggest a couple rules that you might start with. So rule number 1, you're going to execute on point number 3 I brought up. You're going to write a 1-page summary for each of your investments, and you're going to do it for all the investments in your portfolio right now and every new one that you have. Rule number 2, don't chase the share price. If you go back to rule number 1, you're going to write that summary. Part of that summary is going to have a baseline value. You want to buy something that's selling for cheaper than it is. And once you kind of sort of set that price, whether it's, the thing is worth 50 cents, I want to buy it for 15 cents, especially in these bad markets, you're not going to chase it if it spikes up over 20. You're going to let it come back to you at 15 cents, and that's where you're going to buy it. Volatility is make it your friend, not the point that destroys you. And so you're going to wait. You're going to put your order in, and you're going to wait for it to come back at 15 cents. And you're probably going to add in, I'm going to buy in 3 or 4 tranches to make sure that share price goes down further. I'm going to dollar cost average it. Point number 3, or rule number 3, sell the company once it hits its price target. As I said, so many people get focused on the buy side, and that's great. But what they forget to do, or what they get susceptible, is to being way too greedy when it comes to the sell side. And this is a huge mistake, because when profits are there, profits can be fleeting in this sector. You need to take them. And like I said, you need to take them, redeploy into new, cheaper opportunities, or put it into real things. And so selling is such a big part about being an investor in this sector, and you got to get a hold of it. And for me, that's that one last point that I had, that it took a mentor really to hammer into me. And then again, I still made the mistakes looking back to 2020, and then I could be better even in 2023. But selling is a huge part of it, and you can't be greedy. You have to understand what market you're in, take those profits. These are simplistic examples. Obviously, you have to come up with your own, but this is going to be a part of your self-awareness thing. in which you read from part 4 in those 2 books, and how you're going to create a framework for yourself and keep you in your zone of competency and comfort. And if you do that, I guarantee you're going to make better investment choices. That's it for me, guys. Thank you for listening. See you in 2024.